Morning, everybody. How are we doing? So, always late on a Thursday. Gym day. How is everybody? Morning, Christian, Peter, Danny, Kennelly. No, not Kennelly. JC even. Kennelly's in the afternoon. Morning, Yoko. Gregor's post. Wet hair day. It is wet hair day. Morning, Martin. Yeah, there's Kennelly. Sorry, no, you are here in the morning. Sorry. Literally, I've just sat down. Got back from the gym. Aussie dollar Swiss has just hit ADR. Look, how about that for timing? Aussie dollar's running against the Swiss franc. We've got a lot to go through this morning because we've got to dissect non-farm payroll, not non-farm payroll, FOMC, and it's interest rate day today for Europe. So it's going to be a busy one today. Obviously the rate yesterday came out as expected, which is what we were expecting. The statement, I had a brief read through it yesterday as it was coming out, and Powell was talking, and it's basically talking up the danger of disinflation. Basically, it's coming down faster than expected. Well, not faster than expected, but there is a danger of it coming down faster than expected. So the same problem that Europe are having at the moment. They're down at 2.4. Came down at 0.5 last quarter. They're at 3.1, came down at 0.1. The danger is if you overshoot that 2% when you've got interest rates this high, it will accelerate this inflation, which is awful for the economy. It contracts the economy, causes all sorts of problems. So that's what they're trying to avoid. So the basis of what was said yesterday in all of this was we will be bringing interest rates down probably almost definitely early next year, but probably by more than you will expect. So roughly 1.25% to 1.5%. So bringing it down quite quick. But we'll go through that in a little bit. So today we've had the Aussie unemployment change. Aussie unemployment change came out very, very positive. We were forecasting it to have gone down to 10K, actually went up to 61K. So more people employed, less unemployment. Well, the unemployment rate has gone up, which is not good. But the employment change has also gone up. So it kind of cancels each other out. This one is the most important, really, the negative. So the unemployment rate is what the market is really looking at because this costs money, basically. So it costs money for central government. So that's the one that's important. If we look at the Aussie today, you can see it's had a rally. So again, what happens in the news doesn't necessarily mean it's going to go the way the news indicates. In this case, it's had a bit of a rally, but I wouldn't say there's anything exciting in that news event. The main news we've got to worry about today is 8:30, half an hour after the market open. So in 35 minutes, we've got the SNB rate. So the Swiss National Bank are notorious for not saying anything about anything ever. They never talk. When they do talk, we listen because we don't get a lot of information out of them. But they do drop the odd unexpected rate change. So as last time in September, they said we're going to put the rates up. They didn't. So they say they're not going to put the rates up. They could do, or they could drop them. They could do anything they like. But the Swissies quite influential in the fact that we obviously put money into and pull money out of the Swissy in times of crisis. Whenever we want somewhere safe to put it, we put it in the Swiss franc. So when we get unexpected results on the Swiss franc, we tend to get quite big movement. So we'll see what happens this morning. I would imagine this morning you'll find that the DAX will probably be a little sticky at the open. So we'll have a look at the DAX in a minute. But that's the first news this morning. We've then got the press conference at 9 o'clock. So when we get that rate, the market will have an instant reaction to that, which will either be a whipsaw or if it comes out as a different expected number, we'll get a big move in one direction or the other. And then when the SNB press conference starts, we'll find out what their forward guidance on interest rates for the future is going to be. The Swiss have no problems with anything at the moment. Their inflation is sitting at 1.4, well below target. It's coming down as well. They've got very tiny interest rates. Everything is going well. The GDP is absolutely fine. Their unemployment is virtually zero. These are probably the people that just don't need to work because they've got loads of money. It's an incredibly rich country. So they never have any issues. So that's coming out, but will be a big one if it gets a deviation. We've then got 12 o'clock. We've got the bank rate for the UK, 5.25. No expected changes there either. Same for the euro, 4.5. Their inflation is coming down way faster than everybody else's. It's lower than everybody else's, and it's accelerating at a rate of knots as well. So although they haven't indicated any changes, that's the one today that if anything is going to change, I would say quite possibly that will be it. So that comes out at 1:15. Then we've got retail sales for the US unemployment claims, and then followed at 1:45, half an hour after the rate is announced for the euro for the ECB press conference. So absolute chaos today, potentially, or absolutely nothing will happen. But it's big day today. So looking at the DAX, we're gap up situation this morning. We looked at this yesterday morning. We started trading this yesterday morning, and it looked like we were starting to roll over. We were like, yes, look at this. Oh, it's fantastic. And then boom. FOMC. New high again. So what do you do with this thing at the moment? It's just a crazy beast. We are gapped up after a rally. This could go absolutely anywhere today. Obviously today we've got the ECB rates, we've got the Swiss rate, we've got the pound rate. This thing is probably not going to go too mental ahead of the rates. However, having a move up like this, there is potential that it might have a bit of liquidity coming in at the open. We'll see. But your guess is as good as mine on it today. It's just nuts. Absolutely nuts. Yesterday, we haven't got out the inside, out the initial range yet. So yesterday, I made a small loss yesterday. It's getting so difficult to try and extract money now out of these indices. We're really not getting a lot of volume in the market at all. So I think today's probably going to be my last day trading, because we're just not able to get enough momentum really to get anywhere. So there you go, short on the DAX. Perfect target today, 2R is gap fill. That would be lovely if we can just pop down, get the gap fill and complete, and then we'll probably go into rotation until 8:30. Although I'm not expecting necessarily to get that much movement ahead of the SMB rate, but we'll see. So yesterday was so difficult. You can see here, this was the NASDAQ yesterday. This was the open. It's just not doing anything. It's not going anywhere. Nothing is going anywhere or doing anything at the moment. The markets are really slowed down. So it's just, you've got more chance of getting either hedged or multiple stop outs if you're using the ORB EA or any type of stop loss strategy. You're going to get lots and lots of false signals. The market's going to show you it's going short, then it's going to decide to go long, then it's going to go short, because the algorithms are just playing up and down all the time, just making money. There's no speculative movements going in. Nobody's taking any long-term positions at the moment because it's coming up to Christmas. Everybody's looking to get flat. Just no volume. So I'm going to watch the New York Open today. I'm still working out. Let me stop. So yeah, I'll see how it goes this afternoon, but I don't think I'm going to do anything more this week. Tomorrow's PMI day. So it's the last day of the month. Well, it's not the last day. Next week, obviously, is the last week, but it's the week before Christmas, which is usually really dead and flat. But it's tomorrow is really the last proper trading day of the month, the quarter, and the year. So today and tomorrow, we've got a very high chance of a lot of movement, as banks and institutions try and get their positions as flat as possible. First of all, so they haven't got to worry about them over the Christmas period. Second, so they can get paid. So we'll see where we go. But as you can see, it's just so slow at the moment, everything. We're not getting any good explosive movement. So it's very difficult to make money. But we'll see if we can get this short today. That'd be lovely if we can get the gap fill done by 8:30. But yeah. So Aussie, New Zealand, we got some more movement there on ADR. So there's another ADR hit there. So a lot of movement on the Aussie today off the back of that news. So FOMC. Let's whiz back to FOMC. Hi, financial juice. Let me back. Okay. So there's your announcement. 5.5. So the initial reaction was negative to the dollar. So we had the initial spike down. If we look at US dollar Swiss, it's probably the easiest thing to look at. So we had the big move down. We had a very, very small pullback. And then this morning we've continued that move. So today, there's a good chance that we're going to continue that drop on the US moving into the new year. But there's no reason for the market to overreact and really pile into this US dollar short at the moment, coming into the new year. So I suspect we'll probably come back. It looks like we are already anyway. Come back and test this, although this is the Swiss franc. It's probably not the best thing. Mind you, it's almost impossible to pick anything to look at today because the Aussie's already moved, the New Zealand's already moved, and we've got the euro, the pound, and the Swiss moving this afternoon. So the only thing you can really look at with any indication of how strong or weak the US is at the moment is the US dollar yen. And as you can see, it's down. So it's basically probably going to do something along those sorts of lines moving forward. So more short than long. This DAX is just going to whip around today. There's your 5-minute opening range in. This is going to be a hedge this morning. I knew it wasn't worth trading today. So basically, I suspect we're going to continue to the downside. So the initial reaction from the market yesterday was negative. The unemployment projections are still remaining high all of next year. Everybody in FOMC voted to stay where they are, which is, again, a little unusual in itself because we keep getting one member coming out saying we want to hike rates, and then another member comes out 10 minutes later and says we want to dump rates. Another one comes out and says we'll keep it the same. But they all actually voted to actually do the same thing, which is keep it the same, which is good. But this is the probably the most important thing said. The forecasts show a wide range of projections for 2024. So this is the dot plot, which is basically the forecast for inflation moving forward. So 2024, 2025, 2026, and further on. You can see all the way into 2026, they're looking basically for rates to be down at the 2.5% area, whereas we're sitting at the moment, obviously up here at 5.5. So this is the range now for 2024, going down to around about 4. So that's a 1.5%. But most forecasts at the moment are around about 0.75. So because we don't know how fast inflation is going to drop, they're keeping basically themselves open as to how quick they are going to reduce rates. But the important thing is they are going to reduce rates. There wasn't any indication yesterday of when, though, which is what we were kind of hoping for. The forecasts were in here somewhere. Are quite varied as to when they're going to do it, starting early next year, sort of March time, and then moving forward. So there you go. There's one there, a May rate cut, 90% chance of a May rate cut versus 80% before. So more confirmation that we're going to do it earlier rather than later. Again, that's what the ECB have also said. We thought we were going to do it November next year. Now we're looking at March, April, May next year. So rates coming down faster means currencies declining faster. The rate under 4% by 2024. That's basically the 1.5%. Basically, they're saying by the end of next year, we'll have knocked 1.5% off, which is probably about right, considering we went up by more than that on the way. We're going to come down because you've got to get down on top of that inflation figure as fast as possible for the US. Lots of stuff about the labour market, unemployment, etc., etc. So this is Powell speaking. again, it's all kind of very much the same as we always get out of Powell. It's very woolly. We will be data driven, that sort of stuff, but very much a case of we are definitely going to be dropping those rates and faster than you would expect. So it's all bearish basically, which is why the market had that initial dump. We haven't had much of a continuation on it to date. So I think we need to just wait and see what happens. And because it's the end of the year, and they've announced this like a week before Christmas, I doubt we're going to get an awful lot of movement coming off the back of it. 25 basis points in March, May and June. So Goldman Sachs forecasting the first one to be end of Q1. FOMC indicating more like May. Goldman thinking it's going to be faster. So, everybody's got a slightly different opinion on it. But at the end of the day, we've got 3 months to drop the US, basically, is the overall outcome of it. So there we go. That's the FOMC side of things. So basically, you want to be looking more for shorts than longs. Oh, brilliant. Nice. Cheers for that, Dax. There goes my morning. CAD Swiss just hit ADR. So yeah, basically, if any short positions, any RSI extensions to the upside on anything US are going to be much more fun to trade than anything you try and take long moving forward. But as the US comes down, it will be coming down like this. It doesn't just go parabolic. Don't forget as well, the thing with the US dollar is this is the largest currency we've got. It's the biggest, it's the world's currency. Everything is transacted in US dollars. Therefore, when the US dollar starts to decline, everything else is also going to decline. Don't forget, the pound are going to be dropping their interest rates. The euro are going to be dropping their interest rates. The Swiss are going to be dropping their interest rates. So although the US is forecast to decline, so is every other currency. So it's a case of who declines the fastest. Yeah. So if the US dollar is weak, however, the pound is weaker, the euro is weaker, and the Swiss is weaker than the US dollar is still going to go up against those currencies. Yeah. This is an exchange rate between two currencies which are all going to decline. Yeah. So bear that in mind. It doesn't mean you should only be doing that. Yeah. This thing's going to rally when the euro drops its rates. The US dollar, the euro US dollar is going to go down. Well, let's use the Swissy as an example, seeing as I'm on it. When the Swiss drop their rates, US dollar Swiss is going up. Even though the US dollar is forecast to drop, this is still going to go up because the Swiss franc drops its rates. Yeah. So everything's got two ways it can go. So it's a weird situation we're going into. We've had 18 months of everything being strong at some point because everything has been massively increasing interest rates. We're about to move into 2024, where we are going to be dropping those interest rates for the next 18 months or more and more. So where we've had all of this bullishness, we're going to get all this bearishness now. But, everything has been doing that, depending on which is the strongest and weakest currency. So it doesn't really affect us in the fact that one thing is going to be stronger than another. We've been looking at the bias scorecard, and nothing here has been massively strong or massively weak all year. That shouldn't change. So it should be a case of you can pretty much trade anything in any direction, unless you are finding there is one currency which is not stubbornly reducing their interest rates. They are going to remain stronger than the other. So, but we'll find out over the next sort of quarter. So overall, not a lot really out of that, but short-term weakness on the US. DAX has broken out the longs, so I'm hedged on the DAX. There's no targets to the upside to look at. DAX, it's going to be one of those days today. I'm in danger of basically just giving all my profit for this month away, which is why I don't really want to trade the US this afternoon, to be honest. I'd rather just take this money and run at the minute, because this market is going to be very flip-floppy. I got out of the Euro CAD yesterday. Finally, so got out on the news on FOMC. So I've managed to bank that totally flat. Nothing to manage over Christmas. I don't even have to look at a chart. I will do, but I don't have to. I'm not managing any positions over Christmas, which is lovely. 5% bank this month. I haven't been trading for the last week and a bit, so that's not bad. Happy with that, considering I'm taking 2 weeks off and I haven't really traded much at all this month. I literally traded the first week, banked that, and I've just been closing positions out. So yeah, but I'm flat now, so all done. We've got 15 minutes until the Swiss rate. So looking at the DAX today, shouldn't really have traded it this morning. I mean, we're out all-time highs. So where do you go? This thing is just not stopping. It's getting hard to get the entire move on the chart now. Look, but that is the start of the move. Back in November, we haven't stopped for the entire month of November, and December, which starts there, we continued on our merry way. We've had 2 days. It looked like it was dropping yesterday, and FOMC put a spanner in the works by dropping the US, which rallied all the US indices. And obviously the DAX rallies with that because everybody's buying stock sectors. That's continuing. So the Santa rally, which we usually start end of last week, beginning of this week, looks like it might be on the cards. So long all indices, but we will see. So this one, obviously today, the DAX, there is no upside target to pick. So when we get to ADR, that's really where you want to look at trying to get out. So as you can see, 5R there is my upside target. I'm going to move this up. In fact, what I'm going to do today, it's difficult. This is dangerous today. Because we got the Swiss announcement, obviously the Swissy moves to the euro as well. If that Swiss franc comes out with an unexpected result, we're going to get a big move. Potentially, you could look at 150 ADR. So I'm just moving all of the targets at the moment way beyond ADR. So that's ADR. So roughly 150 ADR, something like that. Reason for that is I don't want to take profit on a spike. I want to see what the market's reaction is. If the market suddenly does this and puts in a 100 plus ADR move, I'm going to be taking profit, and then I'm just going to be in massive drawdown on the opposite position. So I'd rather have that spike and be able to make a decision on it afterwards. If it doesn't spike off of the news at 8:30, we've got the press conference at 9, which could well start some volatility. So I just want to give the DAX room today, because we could see some pretty violent movement on this when we get the rate in 15 minutes, just to protect and keep that locked in basically at a loss, because I don't want to get out obviously of one side on a huge spike. So I'll monitor that for a bit. We'll look at that. There's no upside targets. Downside targets ordinarily, obviously, will be gap fill and that pre-market, well, it's not really pre-market, but that area yesterday where we suddenly broke on FOMC. This was acting as a beautiful resistance yesterday. So we had that when we were looking at this yesterday. That was the previous day's move. Yeah, and we said, we closed, we pushed, we broke, we gapped up basically. That was resistance yesterday. We couldn't get through that level. And then we basically tried to rally into it yesterday and failed. And we were like, right, well, this is now looking like a rollover because we are starting to drop. And then FOMC. So downside on this, you would have to say, we know that level there was where we were starting to drop. If they've decided, no, we're going to go long, that will probably become support on the way down, which is beyond ADR. Everything's beyond ADR, basically, if that news event comes out as a shock today. So just going to give it some room, basically, today. ADRs, we've got loads. There's a few RSIs now, as you can see. We've had an awful lot of movement. So I've got the EA turned off. So I ordinarily would be in all of this with first positions today. I'm not getting in anything, obviously, because it's Christmas. But if you are trading over Christmas, you're going to be getting into all of these today. So lots of opportunities for entries. We'll have a look at all those in a sec. And ADRs, there's quite a few. this morning as well. We've got a lot of weekly range hits as well. So we'll have a look through all of that. We just catch up on the chat before we go and have a look at all of this stuff. Morning, everybody else I haven't said morning to. Eri, Naveen, Ismet, Gilad, Altro, morning. Amy, Mark, Jazz, UK 100 hit 2R long. Good job. Got my account. Well, I haven't got my account set up actually for the FTSE yet. I'm still deciding who I'm going to use for the FTSE. Still haven't decided. Aussie again going mental off the back of unimpressive news. Yep. Everything you get this week is going to be not necessarily falling in line with what you would expect from a directional bias. So when you get good news, it doesn't necessarily mean that we're going to go up. The banks and institutions and the funds have got open positions, and they will want to get out of those positions very soon. This week, really, maybe next week. It depends. You never know how well anybody's working, really. But we know it all dries up week before Christmas, so they're going to want to get out of the positions that they're in. So they use news because news has liquidity. So when you need to exit positions and move the market, you use the news because you need the liquidity to move the market. You need another side to your order. So you'll find that you'll get moves in wrong directions, which will usually get undone because they'll be using it basically to get out of their positions, and then other banks and institutions will get back in, or they'll get out in the opposite direction. Weekly range hit on the euro pound. You'll also get a lot of pre-news positioning as well, quite often. So the market will position itself ready for that news event with the expectation of, for example, the euro either keeping their rates the same or dropping their rates. So you might find they start a run short on the euro ahead of the news because they're expecting that to come out. If it doesn't, you're going to find a big correction back the other way as they exit those. So you're going to find some weird movement this week and next week. So it's just all weird. Christmas is just weird. It is just weird. You can't tell where anything's going, which is why most traders just take weeks off because it's too hard. I wasn't expecting DAX to break long today. No, neither was I. But I don't know why I wasn't. But it's a gap. I mean, it's a gap and go at the moment. Look. Let's see if this propulsion holds. But if they buy this propulsion gap up, the thing is they're not going to do anything ahead of the Swiss rate announcement. So this is just kind of clearing the decks, really, ahead of the rate announcement. I don't think this is a speculative move long, unless they're expecting the Swiss to drop their interest rates for any reason. If they do, the euro is going to drop, and that's going to fly. Which is why I want to keep my targets way up there. Because if they do give us an unexpected interest rate today, we're going to see a big move. So, see. I don't think they will, but it's the Swissy. They do what the hell they like. Morning, Neo. Jazzbox update. UK 100 hit 5R long. Very nice. 5R in the FTSE within 10 minutes. I've got to look at the FTSE now, haven't I? Why are you not opening? Yeah. Holy crap, yeah. Wow, that's a hell of a move. So that was your pre-market range. Very nice. Easy entry today. Look at that. Look at that. Wow. Again, stocks. We've got the euro, the pound rate this afternoon. So when you've got an interest rate coming out on a currency, you either want to get out of the positions that you're in. So let's say, for example, you're sitting in a load of pound trades or a load of FTSE trades, which are all in profit. They could all disappear. That profit could vanish this afternoon at 12 o'clock. So you want to get out of those positions. You're going to get out of those positions because you want to be flat. You'll take whatever price you can get. So you will exit all of those positions, meaning that you will need to go further to get those orders filled, which stretches the market. So you get big moves. Or you're piling into a position ready to expect this to be bearish and the stock indices to rally. So therefore you start buying the FTSE speculatively ahead of news. Yeah, you see what I mean? You get a lot of pre-positioning and a lot of exiting because you want to get out. You want to be like me with the Euro CAD. Yeah, I was trying desperately to get out of the Euro CAD ahead of the news because it went my way. Fantastic. If it hadn't have gone my way, I'll be managing this all over Christmas. Yeah, so I could have taken a 0.3% loss on it ahead of the news yesterday. I decided to hold, but a lot of people will have done. So you get a lot of that pre-market movement happening. Thanks for subscribing, Shipcat. Had to be careful how I said that. Thanks. Morning. Welcome aboard. Could it be the last spike up before the drop in the DAX? Could be. It's more of a gap up. I mean, this is obviously news. I mean, this is stock sector purchasing, basically. So, you know, this is them buying the stocks, buying stocks up. So if you're going to take your money out of the US dollar, you got to put it somewhere. So you put it into safe stocks. I would imagine the NASDAQ probably had a bigger run. Oh, no, it didn't, actually. S&P. Interesting. Well, it's very similar, actually, isn't it? But you'll put your money into safe stocks. So you'll buy sectors, you buy the tech sector, buy the healthcare sector, all the stable sectors basically is where you'll buy. Obviously, the DAX is predominantly, overwhelmingly, really motor sector. You've got Porsche, Mercedes, VW, Audi. You know, it's all owned by VW, but you've got all the motor sector in there. But they'll buy the whole thing. They buy all stocks at the same time. Okay, so we've gone stable now. We got 5 minutes to go. We'll see where that goes. Morning, Rajiv. Morning, Ms. Healthy FX. Healthy FX sounds a bit like Helpy FX to me. I haven't heard from them for a while, have we? Right, let me run through the ADRs while we're waiting for that. So Aussie dollar Swiss. That's a nice level. So Aussie dollar Swiss, we've got the 2-week high and last month's high we're approaching now. So good resistance level. We're stretched almost to 125 ADR today. Not quite, but that's a nice extension to the upside. Huge moves on this Aussie, look. So yesterday, big day. This looks like the Swissy had a drop on FOMC as well. Yes, they sold the Swissy off yesterday, along with the US dollar. So Aussie dollar Swiss got a little pump yesterday. And we've had a big continuation move this morning off the back of the Australian news. So the unemployment rate was up, which is negative. Typically, you would find on that, you will find a big drop on a currency, but not at the moment. Doesn't really matter because everybody's talking about interest rates. So, so big move up there. So good mean reversion opportunity on all these Aussies at the moment. Take the next reversal alerts on these. You're coming up to beautiful support resistance area. So, you know, stick half an ADR stop loss on that. There's a good chance you're going to find limit orders triggering up at these levels. Obviously, the Swiss franc in less than 5 minutes is going to move. So can't really get into this now. Get into it if you want to take a short on it now, but you're really relying on that Swiss franc rallying. If it doesn't, you're in deep trouble. So probably not the best thing to do. Take a trade 3 minutes before the news event. Aussie New Zealand ADR again. Look at this price action. Look at the this is no liquidity. Look at the state of it. Utter mess, this thing. But it is an ADR only because of the size of these candles, though. I mean, I'd forget that one today, to be honest. CAD Swiss, big strong run. Swiss franc really weakening, so you're not going to get a reversal alert on that because of the strength of that movement until we get all the way down to there. So tricky one to get into. I would take the lower that wick probably, potentially for a rollover. Euro New Zealand also extended. So these are all going to be the same thing, basically. It's all to do with the Aussie and New Zealand. Again, bit of a mess. Look at the state of that. Price action. That has just hit ADR there, 165, so 154. No reversal alert until you get there. You've missed half the move, so that's no use. These are a bit of a mess, these ones today, aren't they? They're all a bit of a mess today. $50, yeah. Just had a reversal alert on the pound odd. Again, if you get into this, you're getting into a long position, basically a few hours before we get a rate announcement on the pound. Could end up there, could end up 3 ADR down there for all we know. So anything you take today on any of this, you kind of want to be out before the rate announcements come out. News is coming out in 30 seconds. And you got all the New Zealand pairs, basically, which are all extended as well. These are all off the back of the Aussie news. Again, all just a bit of a mess, all extended. These have all sort of played out, these New Zealand ones. New Zealand Swiss hasn't, but again, this is about to move. Let's just watch the US dollar Swiss and the DAX and see where we go. So 20 seconds to go. And either nothing or all hell will break loose. Wow, that's a reaction and a half, isn't it? Have we actually got the rate? There we go. Okay, positive Swiss franc. $1.75, so no change on the Swissy. We'll wait for the press conference. Market initial reaction liking the fact they haven't changed the rates, so everything will be coming down against the Swissy. No reaction on the indices at all. Okay. So no change. So basically, obviously, getting a 1.5 or a 2 would have been what we were looking for to really, really move it like a lunatic. So we didn't get that. So no reaction. Look at that. What a mess. It was just a big, big, big knee-jerk reaction. So we're waiting for the press conference at 9 o'clock where the SMB will lay out their future plans for interest rates moving forward. So again, same as we had yesterday. It's not really the interest rate decision that is the important thing. It's the press conference. Yeah. So the market has already priced in the movement and the expected rate. When we get it, it's a case of fantastic. We got that right. Now, where are you going next? Where do we price in next? Do you want us to go up or do you want us to go down? So the press conferences are what is the mover, if you like. So that's what gives us that indication of where we should be going with price, and that's where the market obviously takes its direction from. CAD Swiss and New Zealand Swiss 125s. A lot of volatility coming in. Look, no movement there. So with the DAX this afternoon, today, obviously the EA normally closes these positions out ahead of the New York Open. But what we've got this afternoon is the rate at 115. So what I'll be doing this morning is trying to look for a way to get out of this towards the upside. And ahead of that interest rate announcement, because when the interest rate announcement comes out for the euro, the DAX is obviously going to get, the DAX is priced in euros, so this is going to get the most reaction today. So I would say the most logical thing for this to do this morning would be to come down and close this unfinished business here. So looking for a move back down to those lows and potentially then a bounce back out of those lows, and just basically staying in rotation ahead of the ECB rate announcement. So there's two ways you can play this. You can either look at this potentially as exiting your longs here and hoping that we get the short gap fill, or wait for the gap fill. If it does that, exit the short positions here and then try and get out of the longs on a pullback. It looks to me at the moment like we are obviously just trying to push back down again. So this is the safer option, because there'll be a lot more people watching yesterday's high to buy it, because we had another update. So you buy yesterday's high in a bull run. So that is the most logical thing to do, is to close your short positions out there and then get the bounce. So that's probably what I'll do. The danger with obviously closing the longs out here and hoping that happens is, if it doesn't happen, you're just going to go into drawdown. So it's a safer play. Either way, if I come out with another down day today and just lock that hedge in, probably just jack it in, won't trade this afternoon. I think the market's probably going to be fairly shot this afternoon anyway, because after 3 interest rates and unemployment claims and retail sales, if the market hasn't done all its movement by then, I'd be very surprised, but we'll see what happens. So just a massive whipsaw of basically an ADR look. ADR is 59. We've just done 57 on that whipsaw. So market just clearing the decks basically ahead of the press conference. Everybody today that has entered long or short is liquidated. Bye. Are the markets logical? No. If the markets were logical, you'd be able to formulate a plan to make money out of them, wouldn't you? If there was logic behind, there's logic behind everything, but there's more irrationality, because the markets are driven by human beings at the end of the day, and we are illogical. We are irrational more than we are logical. So this is why systems and strategies are very difficult to formulate, because everything that you look at on the chart will and won't work at some point. So the only thing you can really establish from any market is the fact that you can see movement in structure. Yeah, that structure does not have a logical way of unfolding. Yeah, so sometimes it will be there, sometimes it will turn there. Other times it will go out the top there and it will turn there, and you'll think it's going down, and it will go sideways and then it will come down. Yeah, there's no logic to it, because it depends on 10 central banks receiving orders from corporate clients at random to be placed into this market. You cannot formulate any logic in that. It's just chaos, and you can't predict chaos. The stuff that will happen, if the US reduce their interest rates, it will come down. The stuff that we know will happen, because it always happens, and there is absolutely no reason to buy something that is going to decline in value. Yeah, that's illogical. So there is some things obviously you can predict. If this Swiss franc this morning had come out and said, we're going to go 1.5, not 1.75, that would have gone through the roof, because you would not put your money into the Swissy, and you would not therefore put your money into the euro, because those two move in the same direction. If the euro comes down, that will go up, because people will pull money out of the Swiss franc and the euro and put it into stocks. Yeah. So there's certain things you can know. And again, you can't distances. You can never know distances. We can roughly know, but you never know for sure, do you? So this is why position trading works, because you don't have to have a logical approach to the market. You don't have to have the market being rational. You have to have the market moving up and down. That's all you need. So if the market's going to move up and down through time, that's the only thing you need to make money, something that goes up and down. Because as a trader, your job is to buy at one price and sell at another price, or sell at one price and buy at another price. So if you're going to have that achieved, you need the market to move up and down. As long as it does that, you don't need to have anything else, do you? You just need to be in it and wait for the market to move up enough for you to take it out with a profit. And every time you think you've cracked something, it will show you haven't. Yeah. Every time you look at an indicator and you go, wow, every time that's happened, you will go, it's happened again. And you will do that, and it will do that. And you'll be like, but every time before it, that happened. It's like, not this time, sorry. Yeah, there is no way of knowing anything. Yeah. All we know is it moves up and down, and it goes up and down often to the points it did it before. It's never exact. There's never a reason that you can determine for anything, because there's too many parties involved. Why position trading is, in my opinion, the best way to trade, because you don't need to know anything, do you? You just need to know it goes up and down. Officially in 4 US dollar longs and 4 Aussie dollar shorts, busy Christmas. Good luck. You'll be fine. It's just going to go up and down. It literally will go up and down for the next week. So just be prepared to get into a couple of positions and then get out. I was replying to your earlier statement, if the DAX is going to move, the most logical point is towards the gap fill. Yeah. Yeah, because we know there is unfinished business to be conducted here. So it would make sense. But again, it makes sense for the market to get this done before the rate announcement, because if you've got unfinished business there, then you need to balance your books at that level, because you got caught there yesterday on a short position and you need to get out of it. It would make sense to drive the market down to that level. And you won't be the only person in that boat, because the banks and institutions all trade in very much a similar way with similar strategies. They just have different amounts of money to do it with, which means that we get the market moving up and down. But there will be a lot of institutions caught offside there. That's what gap fills are. This is why gaps get filled. If you look at any market that has a gap in it, so there's a gap there, got filled. There's a gap there, got filled. Didn't gap that day. There's a gap there, got filled. There's a gap there, got filled. There's a gap there. I'm not going to go on. Don't need to prove the point, do I? I do it every day. It happens. Gaps fill. There's a gap here. If you've got the ECB rate announcement coming out this afternoon, which has the power to move this market dramatically, either with you or against you, would you rather be flat on that order and be prepared not to lose money, or take a chance that it's going to come down? You probably want to finish that off, won't you? So it would make sense to do that. However, I don't know. I'm not in the banks that are potentially offside on that gap as to whether or not they need to do that, or whether or not their plan this afternoon is to do that. If their plan this afternoon is to do that, it can do what the hell it likes today, can't it? Yeah. And this is where the logic, everything makes sense and everything is logical until it's not. Look at the DAX gap here. Can't see it now because it's where is it? That one. Yeah. We never filled it. Yeah, that's what I mean. Every now and again, it will just go, nah, not going to do that this time. Sorry, but I'm not going to do it this time. It's like, oh, fine. What if this is one of those? Yeah, logically, you would expect that to happen. You would have expected it to happen there, but it didn't, because the market can remain more irrational than you can remain solvent. Yeah, there's nothing you can do about it, really. But that's the most logical thing. That's why I'm saying if that happens today, we will probably breathe after that. There's no reason to do that at all today, not ahead of ECB. So if we get to there, that's the most logical place to take off your shorts. Hey, logic, who knows? ADRs, sorry, RSIs, lots of them today. So the Australian dollar obviously has had a big day. So with any RSI extensions or any ADR extensions you get off the back of a fundamental news event, you have to be more cautious with them, because these could be the start of a fundamental shift in direction. Most of the time, they aren't. Yeah. So you tend to find most of the time you will get a pullback at least into the propulsion gap, or you will get a A-shaped recovery back to the propulsion gap. So the RSIs you get most of the time will at least get a pullback, but not always. So all of these basically, as you can see, they're all starting to play out now. So your RSI extension you would have got into there, you would have taken a second one on that this morning, and you're pretty much in profit, ready to get out on that one. Aussie dollar Swiss, the RSI extension triggered literally here. So you've just got into your first short. Probably not, actually. When was the extension? On the last hour. You haven't actually had a reversal alert on this yet, and you're probably not going to get one because of the state of this whipsaw. But it is extended. There is an entry there, short. You're looking to pull back into propulsion. 2 propulsion targets on that one to the downside. These are all extended on the 4 hour as well, all these hourlies, because obviously it's news. So Aussie US, again, very often, if this is going to be a continuation short on the US, we will pull back, and that is where we'll buy up again. Yeah, so this is where they started to sell the US dollar. They will sell the US dollar more, or rather buy the Aussie US when we get back down to this level. So just watch these. If you're going to get into shorts on these, there's a nice reversal alert on the Aussie US today. Nice and tight. There's your reversal. You could look at that as your pattern. But do not try and get A-shaped recoveries out of these off the back of FOMC. Just try and get them pulled back into propulsion. It could go out of here, or it could go anywhere out of here. It could just do that. Yeah, it's Christmas as well. There's so many unknowns going on at the moment. Yeah, it could do absolutely anything. But they're all good extensions, all good opportunities to get in. CAD yen, these I would much rather not get into. Any extensions to the downside, the yen is probably even more no. So now that we know that the US dollar is probably going to weaken a little bit quicker than expected, the yen will power up a little bit quicker than expected, and they're going to change their interest rates possibly in January, which means that yen is going to power up. So I would much rather be short everything yen rather than longing it. So these are opportunities to get in longs. Again, a week before Christmas, it's unlikely they're going to start any massive moves. So you're probably just going to do that. So any of these you get into, it's a good chance you'll be out of them within either today or tomorrow. Because the market's probably not going to want to start some huge moves, is it, a week before Christmas? So CAD yen extended, Swiss yen also extended. But like I say, you want to be short on these anyway. Euro odd is extended. Yeah, so looking for a pullback into propulsion. But again, anything you get into on this, you are literally... as AZ's just said, he's in 4 US dollar longs and 4 Aussie shorts. If you get into a load of euro ahead of the ECB rate announcement this afternoon and it goes against you, you're in it for Christmas. You're not going to get out of it, are you? But it could all go your way. So all these are just, it's risky trading this time of year. Very, very risky. But they are all extended, but they are all off the back of FOMC. So these could just continue these moves. Euro yen, that's another extension. You've got the Euro US as well. That's an FOMC move. Again, we could get an A-shaped recovery on it. We could just be sitting down here and then ECB will rally the crap out of it or dump it. Don't know, one or the other, isn't it? Or none. Pound odd, again, same thing. We got the pound announcement this afternoon, but look at that extension. Highly likely we're going to pull back up into either that as resistance or that. So pulling up into the propulsion gap. We've got the pound yen extended. Again, careful going long on that one. Pound New Zealand. That one's already played out. We've also got US dollar CAD and US dollar yen. So US dollar CAD, this is a more tricky one. US dollar yen, obviously want to be short on that one. Not long. But US dollar CAD, this one is tricky because these two move together. So you can see the reaction we got yesterday was very, very weak. What did oil inventories do yesterday? Didn't look at oil inventories. We rallied it. Okay, so we were looking at oil yesterday. Is this being the ultimate buy and hold from this support, which is triggered? There is a little bit more distance down, possibly for another leg, but with the US dollar weakening and weakening the CAD, it's very difficult to tell what impact that will have on oil. But the OPEC has called 70 to 80 as its target now, so we should really not go much lower than that. The US dollar CAD is affected by oil prices, so as oil drops, it tends to help this rally a little bit because the Canadian dollar gets affected a little bit more than the US. But obviously this is an FOMC move, so this could just continue. As the US drops, it will also weaken the Canadian dollar. Because the US will drop faster and harder than the CAD, this tends to go into like much bigger, stronger moves to the downside. So harder to get out of this because it would also go into these horrible ranges for ages as well. So but yeah, there's loads of opportunities if you want to get into them. You know, it's the same old RSI extensions. We get in, we get out. Yeah, it's extended, and it's coming up to Christmas. Whether you can get out before Christmas, don't know. If you hold it over Christmas, there's a good chance you go into accumulation, and then in January they start a move. So they're just, in my opinion, they're just all very dangerous to get into today. Anything new. Up to you if you want to run them. They're all there. Are you talking about field value gap, inefficiencies or imbalances? No. Fair value gap, you mean? No. In the context of position trading, when you say a position is risky, what exactly do you mean by that? Risky in the fact that you're not going to get the correctional move. So obviously we're extended, yeah, but you're extended off the back of news, yeah. So look at the euro, yeah. CPI never came anywhere near it. So when you get a fundamental shift, it takes a lot longer to come back to it. Look, a lot longer, if it does come back to it, that is. When you're getting something moving that fast off of FOMC ahead of Christmas, if this thing decides to go nowhere today and tomorrow, you'll possibly go nowhere all of next week. Therefore, when we come back in January, this thing could just fly off. So what you're going to be in is a position which is just going to be treated like any other. But when this starts to move next year, it'll be like that. So you can go into more squeezy drawdowns on them, basically. It's just risky because you're not going to get any movement next week. So in my opinion, what's the point in getting into anything? Which is why I've shut the year off last week, and you know I've said for the last few weeks I'll be closed over Christmas. Lots of traders just don't trade over Christmas because there's too much risk involved. Your job is to manage risk. When you're trading over a period where there's no liquidity, you're going to get high spikes, which are difficult to trade, and you're going to get no liquidity, which means no direction. If there's no direction, there's no trading. There's just no point. You know, we've proven it this week with these indices. They're just not moving. Can't trade a flat market. If it doesn't move, you can't make money. That's why it's risky. So the danger is you get into a couple of positions on something today and maybe next week short, for example, and then we sit there all over Christmas and it just grinds away. And then in January, they start a move. So you're in that, and you're taking your third position as they start to move the market against you. So you're already 3 in the hole before the thing goes. Or it will just completely correct. Don't know. Nobody knows what's going on. Nobody knows which way it's going, do they? So it's just a dodgy time to trade. That's all. It's nice to be flat. But equally, all of these can play out. All of these can play out very, very easily. Look, I mean, this is playing out beautifully. Look. But in a normal trade, you would go short and go, yeah, brilliant. And you would either expect it to come and hit your target or not. At the moment, what you've got is potentially just nothingness, just nothing happening. And then obviously all these RSIs just resetting themselves. And, you know, January will be, it's kind of like a clean slate. But, you know. Okay, so we are pulling back. Propulsion gaps filled. So buyers that started that, they weren't really buyers. It was just initial cash balance going in by the looks of things. Just a little bit late. So looks like we are off to the gap fill. So yesterday's high to the downside. So I'm just going to put my targets. I'm going to watch price action. I'm going to put them at yesterday's high, actually. The actual gap fill is about 12, 13 points below. But as we know, this is not an exact science. So somewhere around here, you're going to find limit orders triggering. They may trigger directly off of yesterday's high. They may push down into this area. It could be anywhere around here. But I'll get out here, which is about 2.5R. And then I've got the EA set into aggressive. So it will start to take an additional move to try and get me out of this. With around about 800, so probably be going for about $300 or $400 this morning. If it gets there. Upside, I ain't got a clue. I'm just going to leave it at 5R at the moment. If it pushes up today and doesn't do that gap fill before the ECB announcement, I'll be shutting this anyway. Not much point in leaving it open over that period. But so often we get RSI extensions off news. Bad news on the US dollar is what triggers longs on US dollar, which seems crazy. Impossible to avoid. Bad news on the US dollar is what triggers longs. Bad news will trigger shorts most of the time. But this is what this is what I keep saying. With the news is used to complete orders. Yeah, look at the Aussie dollar. Yeah, unemployment rate increases are good. Yeah, unemployment rate increases are bad. Unemployment rate decreases are good. Only because it tends to affect inflation and allow you to put interest rates up to control inflation at the moment. But what the market uses these numbers for is to get large orders placed in one go. So ordinarily, as a bank or institution, I receive an order to place in a market, and that order has to be split into 100 parts because I can't get the whole thing done in one go. what will happen is they will be able to put the whole thing in one go, which is why you get big spikes on news. Now, that order is basically filling on liquidity because there is liquidity in the market. That doesn't mean it's going to go in the direction the news indicates is good or bad for that currency. It means that it's just going to go wherever it wants to go. The Aussie's gone up today on negative news because they needed to go up. It will probably come back down again, highly likely. If the market goes up on positive news, which is unexpected, it probably won't come back. It will bounce and go. So this FOMC announcement that we had yesterday is them saying, we're going to do what you thought we were going to do. We're going to reduce the interest rates next year. But we're now confirming it's probably going to be somewhere around about 1.25 to 1.5, and it's going to happen 6 months earlier than we expected it to. And I'm actually saying that now rather than you speculating on it. That's negative US. So that could well just continue to go. So when you see these propulsion gaps going in on currencies on fundamental news, this is a fundamental shift, which highly likely will not get completed. That gap will not get filled. It will be used for them to add more orders into if it gets back there. Normal RSI extensions are normal movement. Yeah. So if an RSI gets extended on a news event that is not shifting the fundamentals, i.e. changing the trend of that instrument, you'll get a nice pullback because it's just basically a push and a profit take and a push and a profit take. This could be a push accumulation push because we now want to be really buying the Aussie against the CAD because the US is coming down, which will drag the CAD down with it. You don't know until you know. You get confirmation of a bounce there and you go, yep, definitely. I'm on the wrong side of this. But at the end of the day, once that leg is over, it just means you won't get a profit take on that leg. You will get a profit take on the legs that come after it. So the next time you get an RSI extension, you'll probably get out of it. As I say, you never know. You can't tell. No one knows where anything's going. Nobody knows if the banks are ready now to make a move. They may be, they may not be. The only people that know that are the banks. You will never know that, whether it's going up or down. That's the whole purpose. But we do know, and we can see the same thing happening again and again. Every time it goes up, it comes down. Every time it goes up, it comes down. Every time it goes up. If it doesn't come down that time, it will come down the next time. It's gone up. It's going to come down. Went up. Came down. Went down. Came up. Went down. Came up. Down. Up. All it does goes up and down. Literally, all it does. Because when you buy, you have to sell to get out. When you sell, you have to buy to get out. The amount of movement is dependent on the number of buyers. That is the unknown. How many banks and institutions are going to go long and how long are they going long for? No idea. They don't even know. There's 10 central banks and institutions running this thing. They don't know. Barclays don't know how many orders HSBC are going to place today. If they all place all their orders today, it's going to go like that. If they place all their orders today and they don't place any, it's going to go like that. And then if HSBC do it the next day, it's going to do that. If HSBC have already done that and they want to go short, if they've got more orders short than Barclays have got long, it'll do that. These guys don't talk to each other. Their jobs are to exchange contracts between each other, because if I want to buy 25 billion Aussie CAD, I need somebody on the other side of that order that wants to sell $25 billion Aussie dollar CAD. Yeah. Not many people on the planet that can do that apart from banks. Yeah. If this bank hasn't got that amount that I need to buy, I need to go and find someone else who has, but he doesn't want to sell it until it gets to that price. So I'll have to move the market up to there to get my order completed there. Because I've gone so far, all the speculative traders have made more money. They will need to get out of their positions. But I'm not getting out of mine because it's a commercial position. The speculative people will get out of theirs, which causes a pullback, but only in 50% of the move, because this is a long-term hold for 3 months. This was a short-term speculative move for a week. Then we add more. This is why market structure exists, because there's not an equal amount of money going in and coming out. If 25 billion goes in and 25 billion comes out, you get an A-shaped recovery. If 25 billion goes in and 12.5 billion comes out, you get a pullback to 50% of that move. Then, if 25 billion goes in, you get a new leg up. And then if they don't take any of it out, you go sideways for a bit. And then someone comes along and goes, here's another 25 billion. That's what causes market structure. But you never know when or what. You just can't. You can't do it. You cannot. No one can go, when it gets to that level, it's going to do this. Because when it gets to that level, you have no idea how much money is going long and short at that point in time. If you did, you would be a billionaire. You're not, because you don't know. This is why every course you'll ever do on the planet is useless, because nobody knows. They're just speculating. I can flip a coin as much as everybody else. It's long or short, one or the other, isn't it? My apology, I was a typo. I meant to say fair value gap. Yeah, so that's what I said. Yeah, these, that's what you're talking about. That's a propulsion candle. This is a large candle. ICT calls these fair value gaps. Banks and institutions are placing large orders, which makes the market move up. That's known as an impulse candle, propulsion candle. Some people call it a strong close candle. Just a big move in the market. I call it a propulsion gap because I was taught that these were called propulsion candles. M.A. Perry, the man that invented this strategy that ICT took and renamed, calls them wide range bars. It's just a big order, basically. Which you can kind of see anyway because it's a big candle, but that just highlights where the order is, basically. Thought feeder, DAX, we're down, cool. Okay, so the gap's on its way to being done. So we'll see where we go here. What I might do is just move this down for the minute, just in case, because I can manually exit, but what I don't want to do is have some candle that just screams. Look at the size of that move. 15 minutes solid selling. So what I don't want is a candle that's just going to scream straight through it. If this candle's going to close down there, I'd rather get out there than there. But we'll watch price action now. No, because bad news on the US dollar causes a spike on the euro US dollar, which triggers shorts on the euro US dollar, i.e. long on the US dollar. What? Bad news on the US dollar causes a move in one direction or the other. So bad news for the US dollar. If they move the US dollar down, the euro US dollar will obviously go up. Yeah, I don't quite know what I'm not quite sure what I understand what you're trying to say, AZ. Basically, it will just move up or down on news. Look at the Swiss. So that on that Swiss announcement, what did we get? A total whipsaw. So when the news came out, I said it's good news for the Swiss because the US dollar Swiss came down, which means they're buying the Swiss franc. Then they undid that move, and it was bad news for the Swiss because they were selling the Swiss franc. And then they pulled it back to the middle, and we realized there's no news because they haven't changed the interest rate. That move, that spike, that candle is the banks and institutions executing millions and millions and millions of Swiss franc orders at that point in time because there's liquidity in the market, because banks and institutions and retail, everybody is playing the Swiss franc. They're in the Swiss franc. Therefore, there's lots of liquidity. So I can get all my orders filled today. Because it hasn't gone like that and stayed there means there is no speculative moves on the market on the Swiss franc. Yeah. So there is nobody going, aha, I want to buy the Swiss franc now. I'm going to buy a big amount of Swiss franc and hold it. That is them buying a load of Swissy or selling a load of US, whichever, and holding it. So they're still in this move. This is what the propulsion gap shows you. They sold the US dollar Swiss there. They're still in it. How do we know that? Because we haven't undone the move. Therefore, whoever started short there, they're still short. When we get back to that level, if it drops again, we know that whoever went short there is adding more shorts. Yeah. So we have a speculative player in the market going short. For that speculative player in the market to make money, at some point, they have to get out of all of those shorts. Right. So on that news event, because that went down, you don't know how much of that is commercial orders, speculative orders, or bank and institutional long-term positioning on that instrument. The only way you will know what that order is what happens next over the next few days and weeks. This is why we have the propulsion moves there, to show us where the orders are, because we will either get back to them or not. We don't know. So when we get back to them, we test them and see what happens. So we're testing to see what type of orders are in there. We don't know. That's that's news. News is news to move the market. It's not necessarily going to go in that direction. Again, look, I mean, this is a good example. Look, sold the crap out of it, came back to it, tested it, they sold the crap out of it again. That tells me that we're short the US. And they're probably going to want to stay short the US. Unless something changes this afternoon with the pound or the euro, or US unemployment, or US retail. Yeah, they might just move it back all the way up there and go, screw it, it's Christmas, let's do it next year, guys. No idea. If we knew, we'd do it, wouldn't we? But we don't. What I'm saying is it's impossible to avoid getting caught in the opposite side of news. RSI gets extended to the upside on the EU because of bad news. So we short the EU, i.e. long the US. Yeah. Because we're mean reversion trading. So we are assuming that the market will revert to the mean of the move at some point. What we're looking for, this is how I trade, basically. There's a big move, right? That move consists of three types of orders: long-term investment, short-term investment, speculative, yeah, and commercial. So that's three orders. So long-term investment, speculative, and commercial. Long-term investment orders will be placed into the market and move the market up. They will not come back out again for months. Think COT report, commitment of traders report, long-term futures investment, hedge positions, that sort of stuff. They go in and they don't come out. Commercial orders are executed on behalf of large institutions because they need to transact in different currencies. Those will go into the market. Those won't come out. Speculative orders. The job of the prop desk traders and the speculative traders is to make money on market movement. Those will go into the orders and they will come out quickly. I'm in, I'm out, I'm profit taking. So if you had, as a really simple example, 1/3 of those orders being commercial, 1/3 of those orders being speculative, and 1/3 of those orders being long-term investment, what will happen is the market will move up a distance, and at some point in time, those parties will close those positions by doing the opposite to what they did. So if they bought, they have to sell the position. And 1/3 of those will move back. These are still in the market. Now, at that point in time, when those orders come out, the cycle starts again. Either we get a load of investment orders and commercial orders to go short or long. And in there will be included speculative orders. Yeah. And this is why the market moves. This is the simplest way of explaining it. a percentage of movement will be extracted at a point in time. Market structure, Fibonacci. Think all the stuff you've ever learned about how this thing moves up and down. It's all caused by $7 trillion a day of bank moving money around. That's literally all it is. So if the market moves up pre-ADR and only a third of that movement is going to come out, what's it going to do? Pull back 1/3, 38% roughly. Think Fibonacci, 38 retracement, 50 retracement, 61.8 retracement. What's that? About a third of it coming out, about half of it coming out, about 2/3 of it coming out. Yeah, because if everybody in the world is wanting to buy the US dollar because they're putting their interest rates up, some of it's going to come out, but they're going to keep doing that, aren't they? What we get, trends. The trend is to buy the US dollar because the US dollar is a good place to put your money. It's doing well commercially. Its interest rates are going up. Therefore, you're going to make more money from it. So let's all buy the US dollar. Okay, I'm going to buy it, but I'm going to get out of some of it on the way. I'm going to buy it. I'm going to get out of some of it on the way. I'm going to form a trend. And then they go, we're going to change our interest rates. Oh, I'm going to sell it. Okay, well, I just sold it. I'm going to get out of some of it. Well, I've got to sell it again because I've just been told to, because Microsoft told me that they want to change a load of their currency from US dollar into the yen because they're actually putting more of their chip manufacturing over in Japan now. Okay, so we need to sell a load of that for them. That's it. That's all that drives this thing. Yeah, put as many indicators as you like on the chart. The banks and institutions are the ones that are going to make you money, not the indicators. So when there's a news event and I am told to execute 25 million long, I need somebody going 25 million short. When are they going to do it? When the news is out. Why? Because that's when they're starting their moves. So when there's a load of cash in there, I'm going to inject something myself, which gives you big spiky movements. That movement isn't necessarily the direction that the market wants to take it long term. It's the direction of the most money right now on the news event, which is why you get whipsaws like we just saw in the Swissy. Right, dump all that. Excellent, done it. Right, okay, what are we going to do with Swiss franc? Well, nothing's changed. All right, brilliant. That's what's happening in the banks. Obviously, they're not having that conversation, but that's the logic. That's what we were talking about earlier about, you know, how the market is logical. There is logic in there. There's reason in there, but there's a lot of irrationality as well. At the end of the day, unless you've got a crystal ball, I don't know if this is going up or down from here. What I do know is that there are a load of people caught short yesterday by that gap, and now they're not. So right now, what I just said was going to happen has happened because I know how the banks and institutions work. What I don't know now is whether or not people are going to buy or sell stocks today. We've reset. We've got our inefficiency complete. Our unfinished business is done from yesterday. So now what we're going to do? Do we want to buy the motor sector or sell the motor sector? If we want to buy the motor sector, the DAX is going up. If we want to sell the motor sector, the DAX is going down. That's what's happening today. Flip a coin. I don't know. At the moment, it's coming down hard. So while it's coming down hard, I'm not going to get out. There's a good chance we might be filling the entire move from FOMC yesterday, in which case then we're going to come all the way down here and we're going to retest the previous high before the FOMC move. So I ain't getting out those shorts while this is coming down like a steam train. I need to see some signs of buyers in the market. Until I get a bull candle, I'm not interested in going anywhere but short. I'm in both directions, obviously, at the moment, but I'm not going to get out the longs until I see some buyers. Hopefully that, I mean, I've said it before, but that was quite a good explanation of it, I think. It's probably one of the best explanations I've probably done of it, but that is trading. The only way you make money is by holding things that are in profit longer than you hold things that are not in profit. Yeah. If you get out of the market at a loss, you make a loss. If you get out of the market at a profit, you make a profit. Whether you do that has nothing to do with this thing here and the direction it goes in from a forecasting perspective, because it's totally random, driven by things that are out of your control. Like in the bootcamp, I use the train station explanation. You get on the train, yeah, you want to go in that direction. If when you get on the train, it goes in that direction, there's nothing you can do about it. So get off the train and get back on and hope that the next train goes in that direction. If it doesn't, nothing you can do about it. Get off the train, get on again, and hope it goes in that direction. When the train goes in that direction to the station you want it to, you get off. You can't control the train. You're a passenger. You're not driving it. So if this is coming down, you go down with it and you wait. If you want it to go there to get out of your position, you wait for it to get there. If it doesn't get there, you change the price of it. Only thing you can do, because you can't control it. Obviously, it's December and you want to be flat. But if this FOMC was on February, we'd all be in these US dollar longs. Yeah. You can't avoid it, no. If you're long, if you're in it, you're in it. Yeah, I mean, if you're going to work over Christmas, it's no problem getting into positions. Just be aware, obviously, it's going to be light on the liquidity. But I'm not working over Christmas, so therefore I don't want to have to go in the office, if you like. It's like running a sale. If you're in retail and you run a sale over Christmas, you've got to work over Christmas because you've got to go in and pack the orders and ship the orders. If you don't want to go in and pack the orders and ship the orders over Christmas, don't run a sale over Christmas. I'm not running a sale over Christmas. So basically, I'm not going to work, which is my choice. But you can do what you like. The market's still going to go up and down. Yeah. Microsoft next week are still going to want orders executed. Barclays are still going to execute those orders for Microsoft. It's still going to go up and down. But what you're going to find is the speculative prop desks are going to be empty. They're going to be at the pub. Yeah. So there'll be low. It's like skeleton staff. The commercial desks have got to operate. The investment desks haven't. The speculative desks haven't. The commercials have to. Yeah. If I go to the bank now and I say I'm going to Australia for Christmas, I'm going to go in there and I'm going to say, can you change all my pounds into Australian dollars, please? Yeah. The banks are still going to do that transaction for me, which means I am going to contribute to their commercial order on the Aussie pound. That's all still going to happen. But that's all, which is why you tend to find you get that, or you get this sort of crazy movement, because obviously there's a lot of slippage. 82 watching, 2 likes, really? Come on. I think we need about 160 thumbs, don't we? Everybody's got 2. Come on. I wonder if I purchase ADR dashboard indicator, would it be also showing ADR percentages on the chart? No. So there's 2. The dashboard is the dashboard. The dashboard alerts you when something hits ADR. The indicator draws those lines on your chart. It's up to you how you want to use ADR. If you want to see it, you need the indicator, and that will tell you what the ADR figure is. There's a load of indicators out there you can get which will draw ADR. The problem is virtually all of them draw it wrong. The ADR indicators, most of them, this is why I created my own, because I believe it's wrong the way that they do ADR. Most of them will use today's price action to calculate ADR. So they calculate ADR 10 with today, yesterday, and all these days, right? The movement today should not be included in the calculation for ADR. If this thing moves 300 ADR today, these lines are in the wrong place. We're looking at what the average daily movement has been, because we want to see today, is it beyond what it has been? Not include today in that calculation. This is why most of them are wrong. I think they're wrong anyway. So the dashboard basically just alerts you. So if you didn't have the ADR indicator, on the Aussie Swiss today, and you were looking at the Aussie Swiss without the indicator on, you'd be going, okay, so Aussie Swiss has had a big move up. So I'll wait for some, it's a really bad example, isn't it? Because we just had news. I'll wait for some kind of indication that we're going short. So we pushed up, we made a new low, then we pushed up again, we made a new low, then we pushed up again, and then we got news. But what would normally happen is you would go, we've made a new low, we've made a lower low, and then you get in. Because we've moved up beyond what we normally do in a day, So the chances are we're not going to go much further. That's what the ADR dash is telling you, is we've got a big extended condition. It's likely that we're going to profit take a percentage of that move. Again, going back to what I've just been talking about. Yeah, they've moved it a long way today. That's not all commercial. A lot of that is speculative. So therefore, the speculative stuff will probably unravel because we've done more than we normally do. Market is stretched, that elastic band theory. The bigger you stretch, the faster you snap back. You could stick an RSI on the chart. Stick an RSI on the chart on a lower time frame and go, right, well, the chances are when you hit ADR, you will also hit RSI, because to hit ADR, you've got to move fast and hard in one direction. Therefore, you're probably going to have the relative strength of the instrument showing as extended as well. So if you don't want to use ADR, you could just use RSI. You can tell that's done more than its average daily range without even looking at an indicator or a dashboard or an RSI. You know, you could look at that chart, you'd know RSI is extended. That's much bigger than a normal move, isn't it? And what happens after is a percentage of that comes out, usually somewhere around about 38%. Just, you know, we're talking about logic. It's not logic, it's just what happens. It's just what happens all the time. How we make money. It's how the banks make money, not me. Not us. Well, it is how we make money, isn't it? But it's, you know, buying and selling. That's why they call it the market. Markets are two people disagreeing about price, going up and down. I want to sell my apple for 25p. I want to buy an apple for 20p. Right. Well, either you come down and sell it for 20p, or you have to come up and buy it for 25. That's what the spread is. Yeah. Buyers are here. Sellers are here. One of them has to move up or down for that transaction to complete. That's why we tick. Morning, Mark. I'm configuring my MT percentage terminal 5. MT5 terminal in portable mode. Do you have one terminal with all your charts and EAs running? A second terminal you use to navigate and review your positions? No, I just have one terminal. Well, I've got two MT4s running. One is, I have an MT4 running for every account, basically. So I only have one MT4 running. This has just got multiple charts on it. So that's my chart. That is ADR. That's RSI dash. That's my P&L. That's the DAX. That's the DOW. I don't see what the question. What's the point in the question about portable mode? Portable mode. All portable mode does is instead of storing all of the information that is stored, indicators, EAs, set files, all that sort of stuff is stored in your user directory. When you launch in portable mode, it stores all that information in the MT4 installation directory, so that you can basically copy that folder, move it onto another computer, and it's exactly as it was before. So the reason I run everything in portable mode, as it sounds, is it's portable. So when you install a new MT4 installation, you have to copy over your indicators, copy over your templates, all that sort of stuff. Portable mode means you just pick the folder up and move it onto another computer, and it's exactly as it was before. My EAs are all running on VPS. Yeah, I don't run any EAs on this terminal because I shut this down. EAs have got to be running 24/5. They've got to be running all the time. So all the EAs run on terminal, on VPS. Dashboards are here for me to be signaled when things are happening and to look at stuff. So what do I need to look at today? I don't need to look at that. I don't need to look at that. I don't need to look at any of that. Don't need to look at any of that. So this is basically saying, right, today you need to look at all this stuff. See if there's any opportunities to get into this stuff. So don't need this running on an EA on a VPS because I'm using it for analysis purposes. If it's for trading, that's got to be done on a VPS because when I shut this down, it's not going to be trading for me anymore, is it? So you've got to run all your EAs on VPSs. Or like this one, I don't run this one on a VPS. I'm getting out shorts. I don't run the stock index hedge or the opening range breakout EA on VPS because I'm trading with it. If I was going to run it full auto, obviously that would be on a VPS, but I don't think this is the type of strategy. As you see, you need to make decisions based on what's going on. So personally, I run it on my own terminal. I don't run it on a VPS. You could run it on a VPS. No problem running it on a VPS. You can still interact with all your trades in the same way, can't you? So if this was running on a VPS, the EA, and I shut these positions out here, the EA would still have them shut on its terminal because it's your account that you're operating on, isn't it? You can operate on the same account through as many terminals as you want. So out the shorts, $1,300. Let's see where we go from here. So basically, this is the end of the FOMC move yesterday. Just see what the euro's up to. So euro's coming down at the moment, which again typically would be bullish indexes. Pound looks like it's rallying at the moment. New Zealand is rallying as well. US dollar dropping. Okay, so I've got my aggressive exits running. So this isn't looking great, is it? That's a flag forming at the moment. So just going to run those aggressive exits down until I get triggered, and then hopefully we just get a pullback big enough to exit today. Loss recovery target $400. But I'll be happy to get out with this with break even, to be honest, today. Right, that's all I got for you this morning. Obviously, just managing the DAX now that the gap feels complete. So ideally, just looking for a pullback into propulsion. And then obviously, if it wants to put another leg in, that's fine. If it's going to come up and we're just going to go into a rotation move, all the better. But we'll see what happens with this one. I really can't see it doing an awful lot more than it's done. We're almost at ADR look today. And it's ahead of, obviously, a big potential move on the... there you go. We just tapped ADR look. So it's ahead of a big fundamental move potentially this afternoon. So the next news we've got is 9 o'clock, which is... we've missed that, haven't we? Obviously, nothing happened on that. A rate cut is not for discussion now. Our policy stance is adequate. That's it. See what I mean about the Swiss? Right, that's the Swiss National Bank press conference. A rate cut is not for discussion now. Not talking about it. See you next quarter. That's it. Don't get any clues from the Swiss. Jordan never speaks. Never speaks. You see talking heads coming up on the calendar all the time. Jordan's never there. Never. Just not interested. It's like the today. they're like the head teacher of the Forex world. It's like, nope, what we say goes, and I'm not going to give you any clues. Go and see if you can figure it out. 1.5. That's it. That's what you get. Oh, well, 1.5. Right. Okay. Buy it. It's just crazy. They just don't say anything. So that's it. That's why I didn't even notice the news, because it doesn't move because he hadn't said anything. So there you go. So that's the press conference done. So next news coming up, 12 o'clock. We've got the interest rate decision for the UK. So we don't get a press conference off the back of this one. We've got obviously the rate will be announced, which will 95% sure is going to come out at 5.25. It's not going to change any difference. The monetary policy summary will give an indication. So that will be read sharpish, and that will come out on Financial Juice, and they will give us an indication as to whether it's bullish or bearish moving forward. This gives us a very good clue as to which way we're going. So this is the number of votes for increasing, decreasing, and remaining the same. Yeah. So the two, I think it's that way around. I always have to check this. Yeah, first number is how many voted to increase. Second number is decrease. Third is hold. So this gives us an indication as to how fast interest rate changes may happen. If this number at the front there is higher than or closer to the number at the back, it means that there's more people wanting to move interest rates faster, which means that the decline in interest rates will happen sooner, which is more bearish. So basically, the bigger that first number, the more bearish it will be for the pound. So that's how to read that, basically. So that comes out at 12 o'clock. Then an hour and a quarter later, we've got the euro rate. Again, they'll read through the statement quickly and see if they can decipher any positive or negative stance from speed of interest rate decline. And then at 1:45, we will be having the ECB press conference where Lagarde will set out forward guidance, which is basically hopefully giving us some clues as to when this will change. It's not about now, is it going to devalue? Is the interest rate going to come down? Yes. When? How quickly do we need to be selling our euro positions, basically, is what the banks are thinking. And same with the US, same with the pound. How quickly do we need to get out of this stuff that we've been getting into for the last 18 months? And we've got sandwiched in between that lot, we've got retail sales and unemployment for the US. So this is why I want to be flat on the DAX by 12, basically, because it's all going to go crazy potentially. But, that's what we thought this morning. There could be a potential fast movement. If we get an as expected and there's no change there and the monetary policy statement doesn't give any clues, we may get nothing. But that is highly likely to move the DAX, because even as you saw on the Swiss, even if we do not get a positive or negative stance moving forward, we'll probably get a dump of orders which will spike. And if the euro spikes, the DAX will spike. So at 1:15 is your kind of DAX is dropping a little bit more, is when you're going to potentially get some volatility entering on that. Yeah. So just be careful of that. Where would I re-hedge on the DAX? I need to get into the aggressive position first. Not in it yet. So basically, when I get triggered on the aggressive, usually I look at wherever that low is. That would be my re-hedge if necessary. I mean, if this continues to drop from here and that is just a flag, I would probably look at maybe taking a second hedge there. Basically, I don't really want to go more than a couple of grand in drawdown. So I don't really look at. It's not often you need to re-hedge because something is catastrophically dropping. I mean, it will happen every now and again. But if it goes a couple of grand in drawdown, then I'll probably look at re-hedging it, which should probably be somewhere around about there. So this is previous day's high. Yeah. So you can see, obviously, that's where we got the reaction. So we broke through the previous day's high and then rebought it. Likely we're going to get a bounce out of that. If we don't obviously get a bounce out of ADR, which it doesn't look like we are at the moment, but obviously it's just, flip-flopping around a bit at the moment. So once that is triggered, though, if we then break back down below that low, then I would look to re-hedge. So I'm locking in basically 2 hedges. But yeah, don't know. We'll see where it goes. But I mean, if I'm still hedged and we haven't managed to get an exit by the time the ECB announcement comes out, I will definitely be 100% hedged on it, because that's going to be obviously all over the place. So, but hopefully we just get a pullback. Don't forget, the more extended it gets, the more beyond ADR it gets, the more extended we are, the more likely they're going to get out of that. And they're, think of it from a bank's perspective as well. You really want to be out of any speculative moves by the time the rate announcement comes, because the rate announcement is going to kill you if you've got it the wrong side. So you want to be out. So I'd be very surprised if we don't get a pullback before the ECB announcement. It's whether or not they want to drop it any further. That is obviously the previous day's high, which we rejected yesterday. We broke back through and retested. So that's an obvious bounce point. So if we get down to there, obviously that will be moved down to there in 30 seconds. And hopefully we'll just get that push back out. But I look at money. I don't look at when I'm in this situation, I don't look at necessarily a point. If that's becoming, it's a bit like position trading, isn't it? If that's becoming uber painful, I need out. I need to stop it being uber painful. You've got to pick a point in money. There you go. So just re-triggering the hedge, the aggressive exit rather. Trying to. I'm assuming you are hedging on the trade and you exited the short trade. So how do you manage if the trade goes downward? So I trail that aggressive exit. So this aggressive exit position, when this triggers, will mean that we only really need to move a small amount of distance to get back to profit target. There you go. So we triggered long. So I've got 4 longs. So small move up to somewhere around there is going to get me back to a break-even position so I can get out. If it pushes down, I'll re-hedge. There you go. But if you want to watch the video, every Forex, if you go onto the website and go to the Stock Index Hedge EA page, that video there will explain the strategy. And you probably want to watch the ORB strategy as well. So the opening range breakout EA, watch that video because that explains the original opening range breakout strategy, which the SIH strategy is a variation of. So this is a variation of the opening range breakout strategy. Beautiful 3-bar reversal potentially going in here. So if we can close this candle out bullish, that's the end of that down leg potentially. So we'll see. We need to close bullish though, basically show that buyers tried to take control, sellers put in another leg, sellers lost control, buyers took control, buyers remain in control. That's typically when you start to get these sellers going, crap, we're not managing to get any further. We'll get out of our positions. They become buyers, which makes the pullback. start. But we need to get a decent volume of buys coming in. Kickstart it, really. So the re-hedge will basically be there, which would be annoying if it does get re-hedged today, because it will ruin my month. But it is December. Excuse me. Right. So that's what I'm doing this morning. Just watching this. Hopefully this will be done in 10 minutes anyway. So we'll see. If we get a nice pullback on this back into propulsion, we'll be out and sorted. So, but just be aware of all of that news coming up this morning. Well, this afternoon. So it's chaos. I'll be back at 2:20, and we'll look at obviously how this has all impacted everything. Yeah, just go through the news feed basically and just see what we can extract from it. Some OPEC news just come in. That's interesting. Look, oil market share to drop to a low of 51%. So that is a demand drop in oil. Doesn't seem to have worried oil, does it? So there you go. But yeah, so obviously bear in mind there's potential for some curveballs this afternoon, but I don't know. Until we get that first interest rate move, that first interest rate drop, I'm not sure we're going to get an awful lot of movement, to be honest. I think it's more likely that we're going to get sideways, really, until we get that first drop. When that first drop goes in, I think that's when we're really going to get that move. But we'll see. So yeah, back 2:20 this afternoon, and we will see how we get on. And then I probably will trade tomorrow morning. So I'll probably come back and do the Frankfurt session tomorrow. Might as well. It's Friday. Do the whole week. But I might reduce risk tomorrow just because I'm not convinced we're going to get a huge amount of movement. But it's a big day again tomorrow. It's PMIs all day. Look. So 8:15 we got, and 8:30 we got all this movement on the euro coming. So I'll be back tomorrow morning 7:50. We'll trade Frankfurt. We'll look at obviously the fallout of all of this news for anybody that can't make the US session this afternoon. And then tomorrow afternoon is the last session. And that's it. I'm back in January after that. So tomorrow is the last day. Thank God. Time off. We can work on a bit more strategy development and get everything in place for next year. All right. So have a good rest of your morning. Be aware this afternoon. If you want to trade the news, good luck. Fingers crossed. I hope you don't get whipsawed. I'll be back this afternoon, 2:20. We'll have a look at how everything's panned out, and then we'll trade again tomorrow morning. All right. So have a good day. Anything you need, I'll be in Telegram. And I will see you guys next session. Have a good one.